There are two times in a man's life when he should not speculate: when he can't afford it and when he can. This is a famous quote by a writer called Mark Twain. Now, he famously said this 3 years after losing a £3 million investment. Mark Twain was once described as an absolute magnet for poor investments. Even though he had friends in high places like John D. Rockefeller, he fell for these schemes over and over again. Now, logic would tell you that the more successful and the more intelligent you are, the less likely you are to have the wool pulled over your eyes and to fall for these bad investments. But let's not forget the thousands of people that fell foul to the Bernie Madoff Ponzi scheme. Even Wall Street veterans, which really should have known better, fell foul to this scheme. Now, why did so many people have the wool pulled over their eyes and fell for such a massive scheme? Now, an investigative study by the Better Business Bureau found that 18 to 24-year-olds were 3 times more likely to fall for one of these schemes. This is due to something called the optimism bias, and this is where it leaves people feeling invulnerable and it gives them illusion, and millennials are more likely to get scammed than boomers. However, when it comes to trading, there is something much more sinister. Now, have you ever thought, and stay with me because this may be a little bit random, that even though you know nothing about the weather, nothing about the sky, nothing about the clouds, you can still look up at the clouds and you can find random shapes. One minute a cloud may look like a lion or a roaring tiger, the next minute it may look like a turtle or some kind of snake. So let me explain what I'm getting at. One favourite tool and the best friend to every trading marketer out there, and that is charting patterns. Whether it's from a bullish flag, a bearish pendant, a double top, a double bottom, head and shoulders, the list goes on and on. Now, it's unclear exactly when these charting patterns were first discovered and who discovered them, but there are traces going back all the way to the 1930s of the stock market traders identifying these patterns there. Now, you will find these patterns everywhere, whether it's in a free ebook or somebody's free online course, you will see these patterns constantly. Now, these patterns are accessible, they're easy to learn, and they will really make you feel like you are getting onto something. However, all of these patterns are completely useless. Okay guys, let me just stop things there for a minute before we go any further. I can completely appreciate there's probably some of you guys watching this that are going to find it hard to understand and that are going to straight up disagree with some of the points that I'm making and some of the evidence which I'm about to show you. There will be a certain level of cognitive dissonance involved. Cognitive dissonance is where you are presented the evidence right in front of you, yet you still struggle to understand the differences between what you already know and what the evidence shows. Now, when I first started trading, I put a lot of time and a lot of effort into learning charting patterns. I was sold these charting patterns, probably much like yourself, by a know-it-all trader who showed you the profitability and the strategy used with charting patterns, and you probably thought you were really onto something. This is what happened to me. I thought I was really onto something and I really focused all of my attention onto charting patterns. Now, a bit later on in the video, I'm going to show you the evidence against this and the studies which show that they do not work. We're going to talk over some of the points of why people try and sell you charting and trading patterns, and we're going to help clear up some of the myths which have been missold, mistaught, and you just misunderstand about trading Forex. So let's get back to it. There have been so many independent and empirical studies over the years looking at all of the available chart patterns out there. These studies were undertaken to firstly find out if any of these patterns have any predictive power within the market, and secondly, to see if they can provide any profitable edge to a trader. All of these studies have been undertaken by academics and professors alike, but they were all using a very objective and neutral approach. All of the major academics and big businesses found positive results. Surprise, surprise. This is usually because in one way or another they just want you to part with your cash. So if you look at the outcomes from neutral tests from people who have no invested interest, the results are very different. Now I must say I have absolutely no reason to be against charting patterns other than the fact they have lost me money. If they did work, I would be using them myself and I would be using them on a day-to-day basis, and charting patterns I will be sitting here now explaining to you that they are profitable and how they work. But unfortunately, study after study, whether the studies were taken independently, empirically, or by professors and academics alike from major corporations, even the New York Federal Reserve conducted their own study, and the results each and every time were completely random. These corporations and professionals were undertaking these studies with a completely open-minded, unbiased approach as to what charting patterns profitability actually looks like. Now these results weren't just slightly behind what they were thought to be, they were completely random. It didn't matter which charting pattern was used, even the most famous and renowned charting pattern, the head and shoulders pattern, was found to be non-profitable. There are studies out there which do show positive results for charting patterns. However, these studies were undertaken by companies either with some underlying factor as to why the results showed the way they did. For example, they were undertaken in very new markets which were yet to mature. These are called infant markets, and these just react in a different way, and because they are new infant markets, the charting patterns happen over and over again, and because there is less fundamental value, less force driving these markets, the charting patterns turn out to be more profitable in these cases. There are also other trading companies which it's just completely in their interest to promote these charting patterns as profitable, as it will help sell their products. They are easy to understand as opposed to some of the other strategies which are used in Forex, and it's just a sales pitch to get you to buy their program. There are many different studies focusing on many different points, but they all have some similarities. Firstly, some charting patterns were found in real price charts also appear in randomly generated artificial price data. If these patterns are found in completely random price data, that should show you and prove to you how these things emerge. In other words, they are just random occurrences. The number of times these patterns appeared and the characteristics returned after they appeared were similar for the random data and the real data, meaning there is absolutely no difference between real price movements and random price movements. So in other words, they have no meaning within the market. So some of the patterns were found to have predictive power, I will admit, but unfortunately it was not in a way which was tradable and which was able to generate a profitable, consistent return. This means that the patterns were suggesting which way the market was moving, but they were not able to return a profitable trade. So to sum up that last part, let me give you an example from a study from the New York Federal Reserve. Now, they found that with the head and shoulders pattern, which is the most popular and most commonly used available, activity increased when the pattern emerged, but this was no indication of any profitability. The New York Federal Reserve themselves described a head and shoulders pattern as just market noise and not a profitable strategy. So despite being used under different market conditions and with different approaches, there is one massive benefit to them. It is really easy to show them working in hindsight. So scammers and marketers are going to love that, and it's easy for them to sell this trading strategy. So this is why so many people still believe that they work. It's called the clustering illusion. Now we spoke about this earlier in the video with the clouds. So with these studies, they were done with random data and not real data. This is because the same patterns would appear in random data as they do in real data. Results altogether are random and there is no predictive power with these patterns. If they emerge in random data, that tells you exactly what they are. random. There is one reason why people still believe they work, and that is mainly due to overconfidence. Most traders don't realize they are being overly confident. This is due to two biases. The first is self-attribution. This is where a person assigns success to their own skills and its failure to acknowledge any external conditions. The second bias is hindsight bias. This is the tendency to give emphasis to information that confirms rather than contradicts your beliefs. So in other words, it's the I knew it all along bias. This means when you see something that you thought was working, you're immediately going to jump to the conclusion that it's a profitable strategy. In addition to all the things that are being proven within this video, there are still reasons why these patterns can appear to be profitable, even when they aren't. This is the same with any method that uses vague entry points. This pretty much gives people a very wide berth, so you will have a very wide stop loss and a very big take profit margin. And the entry and stop loss zones are very vague. You will have something like 10 to 1 or maybe an 8 to 1 risk reward ratio. So that price can just float around and eventually it will hit one side or the other. Okay guys, I think I'm going to wrap it up there. Thank you all for watching. I'm going to make a part 2 or a follow up to this video and show some more strategies and do some more content similar to what you saw in this video. In the meantime, follow me on Instagram and make sure you click the link in my bio, because that will get you into a group which is completely free, and every time I update a chart I'll post analysis and upload it to Upswing FX. I'll put the link in there so you get notified straight away, and I will do that 2 or 3 times a week, keep you guys updated what's going on. And anyone who's interested in working with me one-to-one, go over to upswingeffects.com/coaching. You can apply to work with me there, and I'll teach my strategies and how to trade effectively and use trending markets. So thank you all for watching. See you in the next video.